Okay, step 4 is we need to determine the discount rate. And what that is just part of the mechanics of the process. We have to take the present value of all those free cash flows that we just forecasted. And taking a present value involves estimating the future value and then discounting that future value back to today. And the discounting part comes from the time value of money. And again, if this is sounding unfamiliar, go back and watch I've got lectures posted to YouTube from the intro class. You've got the review material, but we need to discount those future values back to the present. And to do that, we need a discount rate. We need the rate of return that we are assuming these cash flows are generating. And for a firm, the appropriate discount rate is what's called the cost of capital. Remember, capital in finance is just money. So the cost of capital is the cost to the firm of raising new money. And capital comes from two main sources from the firm, debt and equity. Now there are more. We'll go into more detail when we do a WAC chapter about different sources of capital, how we might account for those kind of things. But in our standard firm, there are just two sources of capital, debt and equity. And the cost of capital is the weighted average cost of those two sources, right? So hopefully the WAC formula is something that you're familiar with from your previous classes. Hopefully calculating the WAC formula is nothing new to you. Certainly you'll see it in your homework, you'll see it on the exams, and you'll need to be very familiar with it going forward. Okay? So this is essentially saying that we are going to discount the free cash flows of the firm based on the cost to the firm of raising the money to generate those free cash flows. Okay? Now, it is important within this model that the WAC is relatively stable. Okay, so the discounted cash flow model does not handle changing WAC very robustly. Okay, so the cost of capital for the firm needs to remain relatively stable within our model, or the discounted cash flow is not appropriate. If for some reason we assume that the cost of capital is going to be changing in a big way, then we need to use a different model. We can use the adjusted present value model. We can use one of the other models that handles a changing WAC. Okay, so particularly important in terms of changing WAC is that we assume the capital structure of the firm stays the same. So the costs can fluctuate. The relative costs of the source of capital can fluctuate more than the capital structure of the firm. Okay, so for whatever reason, we have a firm that's like 100% equity and no debt. And we know that coming up in the future, they're going to release a big chunk of debt as a way to finance a new project. Their capital structure is going to change significantly. And because of that, the WAC is going to change significantly. And that means that probably a DCF is going to struggle to give us an appropriate valuation. Okay, so we've got to be aware of that. It's not a huge deal otherwise, right? And calculating the WAC, we'll go into more detail, and we'll actually do some of this with real numbers and stuff. So stay tuned for that chapter. Right? Now, 5 is where we put it all together, right? We now have our forecasted free cash flows, right? So forecasting for 10 years here of free cash flows from 2014 to 2023. We have our continuing value. This is our terminal free cash flow. So this is the 11th value. And now we only have 11 things to take the present value. So we take the present value of all 11 of those free cash flows, including the continuing value. We add them all together. That is the present value of the firm's future cash flows. And that is what we call the value of operations. Right? And we've discounted all those at the WAC. That's how we got the present values. Okay, so we added them up. That's the value of the firm's operations. We add any non-operating assets, the value of any non-operating assets, to get what we call enterprise value, which is the total value of the firm, or the total value of the enterprise. Right? This is our goal number, right? This is the result of the DCF model. Right? Now, following that, we sort of want to check our work, and we want to value the firm's debt and the firm's equity and see if that matches up to the value of the firm from the free cash flow side. So we're going to calculate the firm's equity value, which is important if you're a shareholder, by valuing all the firm's debt and then deducting it from the enterprise value of the firm to get the firm's equity value. Once we have equity value, we can calculate the value per share, which is going to help us, if we're an investor, that's one of the things that can help us guide whether we make an investment in the firm or not. Okay, so this slide right here, this is the end result. Right? This is what the result of the DCF looks like. And again, this is the easy part. Once we have all this work done, Excel does it all for us and boom, it's finished. The hard part came in steps 1 through 4. Right? That's where the work is. Okay. So the way we move from enterprise equity value is we're going to remove any non-equity claims. So any claims on the firm value that aren't ownership claims. Now there is a lot of different ones, and again we'll have a whole chapter here, so I'm not going to spend a lot of time talking about these, but these are the most common non-ownership, non-equity claims. The biggest one, of course, is debt. If we have a loan, that is a non-ownership claim on the firm. The claim is the firm must pay the loan back, right? So that's what we mean when we say claim. Somebody that has some kind of financial hold on the firm, that is an ownership, right? So one of the other ones is retirement liabilities. This means that the firm has promised, this is a claim by the past employees of the firm. The firm has promised these employees retirement, whether via a pension or a 401k, and that can be a liability to the firm because the firm has promised to pay it out until they die. So that is a non-ownership claim. We can have contingent liabilities. These are usually things like lawsuits. The firm has to pay a lawsuit, something like that. We can have what are called operating leases, although we'll spend some time talking about these. These are not very common, but they are very unusual. And there are new strategies coming out that are sort of similar. Okay. A minority interest in the firm is when a company controls an ownership stake. Somebody else has an ownership stake in us, right? So they have a claim on the profits of the firm. Preferred stock, employee stock options, again, these are typically employee-held claims. They're not ownership claims. So we can have lots of different non-ownership claims on the firm that we have to value. And then we can subtract all those values to get equity value. And that's how we sort of are checking our model. Okay. Now the last step, and again, this is a really important, not to be ignored step, is we've got to check our results and then interpret them. Right? So we get to the end, we calculate a enterprise value of $122 billion for UPS as of 2013. And then we come back and we say, what does that mean? Right? So we look at our model and we say, okay, first, is the model technically robust? Meaning, did we make any technical mistakes? Does the balance sheet balance in our forecast years? That's a common one. You're forecasting all these different things. Assets are growing, cash is growing. The balance sheet somehow comes out of balance and you don't notice. Right? So, do all the accounting standards check out? Do all the financial standards check out? So, are we making any technical mistakes? Okay. Once we're through that, and we can do that in either manually or we can do that in some more clever ways, like setting up automated checks in our Excel spreadsheet that make sure that we get an error pop up if the balance sheet doesn't balance. Right? That checks automatically if the balance sheet doesn't balance and says, boom, here's an error, and then you can go find it. Right? So we can be as sophisticated as we want. Right? And then, of course, maybe more important is we have to look at whether the model is economically consistent. So as long as we haven't made any technical mistakes, the only error that gets introduced in the model comes from our assumptions. Right? So are the patterns and assumptions that we introduce into the model, the way that we think or describe the company changing over time, do those changes and patterns have any economic rationale behind them? Right? And this is a common thing because of the way that we forecast and the way that our forecasts are tied to choices that the firm is going to make. It can cause some just mechanical changes that aren't reasonable. Okay? So we'll spend a lot of time talking about this when we talk about forecasting, because this is a lot of the way that these things are forced into it, right? For instance, we are going to forecast, so here's an example. We will forecast that, typically we'll forecast that our fixed assets will grow as a percentage of revenue. Because the firm generating more revenue is typically going to mean it has more sales. If it has more sales, it has to produce more product. If it has to produce more product, then it probably needs more assets to produce that product, right? It might need more machinery, more space, whatever, right? Now that's true in a broad sense, but it may not be true at the level of our forecast, right? So for instance, there may be lots of slack that the firm can generate before it has to buy more machinery. Maybe the firm's only running the machines 12 hours a day and it can run full 24 hours a day. In which case, we don't need to make any more investments in assets to double our revenue. Right? Now, we don't know that unless we're inside the firm. The level of detail that we have is going to determine some of this economic consistency. But what we want to make sure is that when we have made a choice or an assumption, we have made it for a sound economic reason. And this is just my personal opinion, when you're doing a model like this, anytime you make a choice like this, you should make a note of what you think that economic reason is, just as a note in the Excel file. Say, I chose this because this, here's why I think it's going to do this, here's what the effect is going to be, that's what this choice is. Then, this might take you weeks to do, then you haven't made any, you won't have to be wondering why you did something. And anybody looking at it also won't have to be wondering why you did something, right? It'll be clear from the outset. Okay. Now, the rest of this slide is about, these slides are about the economic profit model. Again, we're just going to ignore the economic profit model, and the next three models are not going to cover it. So that's the end of this lecture. Again, this is the roadmap to the whole rest of the class. So this is going to be really tied in with the example video that I'm going to post, where I'm going to do the UPS valuation from scratch, from the financial statements down to enterprise value. We're going to see if we get the same numbers. It's a good exercise to both follow and to try for yourself. Okay, so keep an eye out that after this you guys have an exam. So don't forget about that, and good luck.